right. So, everyone, we are now starting part 2 of today's call. This is a special training today because I invited both members and non-members to the call. I wanted people that are not part of the membership to get a sense of what we do here, because unless you come and you experience it, it's really hard to describe. Now, the one thing you haven't yet experienced is the Knowledge Center, and I'll figure out a way to let people have a taste of that someday. But for now, you are on our weekly deep dive call that we have every Thursday from roughly 1 to 4 Pacific time, 4 to 7 Eastern time. The first half of the call, we went through our deep dive community call, which today I covered all the 2024 crypto narratives, and then we had our community Q&A. We are now into part 2 where we're going to do our trading class. This is a weekly class, and we will have it every week until we get through all of the material. And then when we're done, if people want, we'll start it all over again. We'll wait a little while and then we'll start it again. So our training is based on material that is freely put out by a guy that calls himself Emperor BTC. He is an extremely successful Bitcoin trader. His short story here is that I think it was 5 years ago, he made a trade and it went against him at the wrong time, I'll say, and he lost everything. He literally went to zero. He got liquidated because he put everything into one trade. He learned a lesson that day. And since then, within 5 years, he has now made, I'm going to try to remember the right number. I have it posted somewhere, 122 Bitcoin. He's like 10 or 11 million dollars, I think he's made in 5 years with his trading strategies. And I'm so grateful that this guy puts out material free of charge. And I have a lot of his material, if not all of it, organized in a special way, and I have it in our membership platform. So this is one of the trading manuals. This is his full trading manual, as he calls it. He's also got them broken down into sections. So I have all those different sections in the membership platform in the Knowledge Center. But for this trading class, we've been mostly going through the trading manual. The very first day, we started out with a different one, and then we decided to just stick with this. So we are at risk management part 1. So good idea to take notes if you don't want to go and re-listen to a long video. The concepts today are not super difficult, especially the first one. I don't know that we're going to get into his risk management part 2. We'll see. The first piece of risk management is really quite simple to grasp, but he repeats it over and over again because he's trying to hone in to get us to recognize how important it is. So I've highlighted what I think are the most important parts of this training. So the fact is that 90% of traders lose money. Now, I've heard it as high as 95%, but this is a trader who's admitting that 90% of his trader buddies lose money. According to him, all of trading knowledge is futile if you don't follow risk management protocols, period. Since 90% of the traders lose money due to lack of risk management, we need to further discuss its importance. If we don't manage risk mathematically, we will for sure lose all of our capital, for sure. Can't stress this enough. In this thread, we're going to try to understand optimum position sizing and what he calls the 5% rule. And he gets a lot of his content from people who have been in trading in the stock market for years. And he's given us their names. I just don't remember them all. And he's got little blurbs here from some of the books. I will tell you that he is an advanced trader. And in his trainings, he often talks about leverage trading. And in my trading class, we are only going to focus on spot, because he also says in his trading, and I 100% agree with it, is that you should never trade leverage until you are successful at trading spot. So he does talk about leverage in this section, and I'm going to skip over some of those, but I've got the pieces that I think are the most important highlighted. He says never risk more than 3 to 5% of your portfolio on any single trade. This is the 5% rule. And is the text size large enough for you all on the screen? I see one person shake their head, one person nodding, some thumbs up. Okay, so it looks good. All right. So the 5% rule, never risk more than 3%, 5% of your portfolio on a single trade. So how did he lose everything in that one trade 5 years ago? Well, what he did was he was in I believe it was a long position, and he was so convinced that his trade was going to work that he put everything in, and he was waiting for it to hit a certain point, and he was going to take profits. And what happened is the market maker, who sees all the trades that are out there, the market maker just made a quick little pullback, and that pullback caused him to get liquidated. And then right after he got liquidated, he said in one of his stories, it then jumped up and hit his target. So he did hit his target. He just missed the fact that they could, market makers are always out there. They're out to get you. It's just all there is to it. Market makers want your money. And so you have to somehow be smarter than the market makers. John says he's been there. That's good to know. I kind of was there too back in the .com bubble, but I won't go back and talk about that. So he says he prefers 3% is what he prefers. 5% is more aggressive. Philippe, yeah, you too back in the .com bubble? Yeah, okay. We got experience here. We got experience about what not to do. So we're going to learn better and better and better what to do. Now, I have been successful. I have made money. I'm not a millionaire yet. I'll be the first to admit I'm not yet a millionaire, but I'm freaking close. I mean, I'm closer than I've ever been in my entire life. And I'm going to tell you that when I started this journey in Bitcoin, Susan's smiling at me because I've talked to Susan at length about it. I had zero investment plan. I had zero retirement plan. Zero. Because I spent my life chasing experiences. I didn't care about money. As a matter of fact, I avoided money because of my family history, which I've got all over the internet and places. You can go read about it. I didn't care about money. I cared about the things I wanted to do: building straw bale houses, fighting forest fires, working in the forest, permaculture. I was a hippie wannabe, and the universe would not let me have it. It wouldn't let me have it. And after living in the back of my truck many, many months at different times because I wanted experiences and I didn't have the money to do it in style.
You have to be rich to be a hippie. You have to be rich to be a hippie.
Yeah.
You might have to be rich to be anything anymore.
Just about. So who's SM that says they can't see my screen? I can't see your screen of what you're speaking about. Well, okay. You can't see the trading manual. Somebody says they can't see the trading manual. Let me make sure okay. So if everybody can see it except for one person, I'm going to have to assume that it might be your screen. Yeah.
You might have to back out and come back in if it's not showing up. It might not be connected your network.
All right. Well, so the bottom line is, I finally decided I got tired of living in the back of my truck, and the experiences were starting to rack up my body. I mean, I was a boxer. Okay, most people don't know that. I actually taught women's boxing back when I was in my 30s. I was on ESPN. They wanted me to go, be more serious about it. But 5'4", 125 pounds. I was scrappy, but not that scrappy. Somebody can maybe talk to whoever SM is, that you, Sui, in the chat, and help him get back in. I'm going to keep going. So yeah, I did a lot of things, and then I finally decided. That I needed to care about money, and I was getting into the market, learning about trading. I paid a bunch of money, went to Seattle, learned how to trade, and then got involved in options and all that right at the top of the .com bubble. And that was the beginning of my experience. I learned a lot. I did lose my shorts. I was smart enough. I got out pretty much broke even. But I did learn some of these things, like the 3%, 5% position sizing. And I'm going to read what one of his, so SM came back in. SM, I'm hoping that you were able to see the screen now. Right, Rosemary? My recording is on, so you can always catch the replay, which I will have on YouTube. So what he's taking a screenshot. Yes, he's good. Awesome. Thanks. SM, is your name Scott or Steve or Stan? You can just put it in the chat. The The total amount risked in any one market should be limited to 5% of total. Sean, I missed it. Sean, thanks for being here. Should be limited to 5% of total equity. This 5% refers to how much a trader is willing to lose if the trade doesn't work. Now, this might sound simple, but hang on. This is an important consideration in deciding how many contracts to trade. Remember, they're talking about options. And how far away a protective stop should be. A $100,000 account, therefore, should not risk more than $5,000 on a single trade. Now, he's going to share something here in a bit that is going to be talking about a concept with leverage, and I'm going to talk about it because I think it makes clear some things. Oh, it's a really good cup of coffee. That's almost as good as Starbucks I did. Trading with only trading with only 5% of your capital doesn't mean your trade position size is only 5% of your capital. Now, that concept he just said has to do with if you're leverage trading, and he's got an example we'll look at in just a minute. And if I don't have it highlighted, I'm going to skip it because I already read all this. Here's his example of what he just said. This is a good written example, I think. This is just an illustration. So pretend like you've got $100,000 to spend, but you only want to risk, you have $100,000 of capital for investing. You only want to risk 5% of it, according to his rule. He suggests 3%, but we're going to stick with his 5% because that's what's in his example. So 5% of $100,000 is $5,000. So your trading size equals leverage times capital at risk. This is if you're leverage trading. If you're spot trading, what's your leverage? Here's a pop quiz. On a scale of 1 to 100, if you're spot trading, what's your leverage?
1 to 1.
1. Your leverage is 1.
1.
So you can use this same equation and just for leverage, and instead of a 10x leverage or a 20x leverage or a 5x leverage, you would just put a 1 there. So 1 times capital at risk in this case would only be $5,000. That's a spot trader. So a leverage trader, he says, let's assume the leverage is 20, so 20x. So the amount then would be 5,000 times 20. So $100,000 is what your trading size is, but you're only risking 5,000. If you set your leverage trade up so that it doesn't use all the capital that you have in your wallet as what's that word I want? As collateral, then you would only be risking in a leverage trade at $5,000 at 20x. You are only risking $5,000, but you're playing with $100,000. So you have the chance, the possibility of making a lot more money when you leverage trade. But at the same time, you can't lose more. This is different from when I played in options, which was way scary because you could lose more than you actually started with.
You can lose up to 100,000.
I like this. Yeah, in this case, in a perp trade, in a perpetual trade on a perpetual exchange, if you set it up properly, you would only be risking $5,000 with a chance of making a lot more because you're actually putting $100,000 to work for you. So leverage trading is something we will get into at some point, but we're focused on.
Sorry.
Yeah,
so this is the equivalent of doing a buy of an option where the limit is how much you put in, which is the 5,000. If you were selling, your maximum loss would be the 100,000. And so it depends what side of the option that you're on. Yeah. So, but you have to understand what you're doing and what side of the trade you're on to know what your limit loss is.
Yeah. So I don't want to spend too much time on leverage because we're not going there yet, but I wanted people to at least understand that concept. I'm just going to skip through. We will learn the application of leverage in the stop loss thread. Okay. But why risk so little capital? If you got $100,000 to spend, he's saying he's only going to risk, in his case, $3,000 on a trade, on one trade. So he's like, why so little? This is a really good thing he's going to share. Per math, even if you have a very high strike ratio, a strike rate, and the strike rate is a ratio of winning trades. He's got some good charts we'll look at in a minute. And let's pretend like he's saying 70% win rate. We'll just call it the win rate. He calls it a strike rate. There will come a time when you will have at least, well, no, not at least, you will have exactly, according to the numbers, 6 consecutive losing trades. I'll show you the chart in a second. High equity risk trades are historically proven to deplete all capital, as explained above and below. The chart below shows the consecutive losses a trader will definitely face over a period of time with the given win rate.
Good.
Now, imagine if someone with a respectable win rate of 70% risked 40% of their capital. So 40% of $100,000, they're risking $40,000 on a single trade. Let's see what would happen when we look at the chart. I think it's next. Yep. So hit rate, just call that win rate. So he was talking about 70%. If you have a 70% win rate, which means 7 out of 10 of your trades go your way, he says that you will, at some point in time, according to the math, which he didn't share specifically the math, you will have 6 losing trades in a row, consecutive, not just 6 losing trades hither, thither. He says the math has shown you will have 6 consecutive losing trades, but you could have 19 winning trades. Does this chart make sense? Everybody give me a thumbs up if that's a yes.
Yep.
Or a nod.
Gotcha. We're there.
Everybody, now there's 5 others whom I can't see. So, Jeff, thank you. So I'm just going to assume that if you don't say something that you're good. We're going to talk more about this.
The problem is if the first 6 trades you make are the losers, you're out of the game at that
You're
point.
out of the game.
Yeah.
You're $40,000. If you lose on one, you're out $40,000. You go to the second trade, you lose again, you're out $40,000. How much you got left?
Yeah.
Simple math.
You're
How much
20.
you got left?
You don't even
20.
have another whole trade. Yeah.
You don't even
Not
have
even-
enough for the next third. So if you're going to lose 6 times, 6 times 5 is 30.
Yeah.
The most you will lose is 30,000 out of your 100.
And,
Right.
and you're far more likely to have the 6 losses in a row when you first start.
Right. Because you're new to it. You don't
No
really know what
way.
you're doing.
No
You're
way,
picking
Thomas.
it wrong.
There's no way in hell I'm going to lose 6 times in a row. I guarantee you. I guarantee you there's no way because I couldn't afford it. I might, but I got a system that someday I'll share with you. I'm developing my own trading system. And so far I'm testing it. I've already made my first.
But your tests are your trades. So
Yeah, well,
you
my
know?
tests are I'm not paper trading. This is for real trade.
Right. So if you've already been
So-
losing, you've already got into your
No,
6.
no. Yeah, I haven't started my 6. I'm happy to say I'm up 40% in that one trade. I'll share with you that it was MVI.
Cool.
All right.
I got to jump off for 10 minutes. I'll be right back.
We'll be here. So in each of the 6 losing trades, as I just said, he would be wrecked. There's another fancy word they use in crypto land, REKT, for wrecked, for meaning you really screwed up and lost a bunch of money. So it might come as a surprise that the most successful and long-term traders have a win rate of only 40%.
Mhm.
Let that sink in. This guy has made 122, if I got my numbers right, if I remember correctly, 122 Bitcoin he made in 5 years. Over 10 or 11 million dollars. He posted it on Twitter. And he's only got a win rate of 40%. And how did he do that? So he's going to talk about that a little bit. The best traders that he knows personally, and even himself, he doesn't have a win rate that's high, that is very high in his opinion. I think he said his is around 35 or 40%. Then how does such a low win rate lead to such profits in the long run? Here's the magic. The reward to risk, I usually call it risk-reward ratio. The best future traders make money on only 40% of their trades. That's right, 40%. Most trades wind up being losers. I say it depends on your time frame, short term. You know, the shorter term your trading time frame is, the harder it is. The longer, in my opinion, the easier it is, because that's what I've been doing now ever since I started in crypto. I decided. Thanks, Rosemary. You can always catch the replay of the trading class here in YouTube, and I'll also post it on the membership site. So how then do traders make money if they're wrong most of the time? I kind of liken this to baseball. You know, a baseball, his hit rate, if it's like, if he's got a .33 hit rate, he's freaking doing good. That's like 30%. Because futures contracts require so little margin. Even a slight move in the wrong direction results in forced liquidation, which is what he experienced 5 years ago. Therefore, it may be necessary for a trader to probe a market several times before catching the move he or she is looking for. This brings us to the question of risk-reward ratios. Because most trades are losers, the only way to come out ahead is to ensure that the dollar amount of the winning trades is great. So we're going to talk about the risk-reward ratio now. I studied this a little bit last night when I was freaking tired to make sure I understood it. I mean, I've known about the risk-reward ratio for years, but I trade with so much intuition that sometimes I don't use a lot of these fancy things that I should be using. But I've started a journal, and I will be monitoring my trades and following what we're learning here so that I can talk about it in the future with you guys. So the profitability is gained from obtaining a good RR, risk-reward ratio, over a period of time. Risk-reward ratio, stop-loss placements, and the use of leverage will be explained in further threads. Now, it took me a minute to make sense of his chart, of his picture here, but let's see if he has some more words down below. Yeah, here it is. Well, no, that he's going on. This is him summarizing what we just said. So let's talk about the risk-reward ratio. I understand it well enough now that I think I got it. Actually, I think I've got a definition down here. Oh, where did I put it? Pardon me while I jump ahead a little bit. Where did I put my definition of the risk-reward ratio? Oh, well, never works out exactly perfect, but let's talk about it because I got it. Does anybody not understand the risk-reward ratio? Or maybe I should say it the other round. How many of you feel comfortable with the risk-reward ratio? Give me a thumbs up if you feel comfortable. Okay. Couple three, and there's probably some that don't. Yeah. Okay. I was with you, Thomas. I was like, okay, I had to stop and think. All right. So it's very simple. The risk reward ratio simply says, if you enter a position where his little line is here, says swing high, he's going to open a position, his entry for a swing high breakout. Okay. That's this little green candle here is his breakout. At that line, he said, oh, it's breaking above. I'm opening a position. So the risk reward ratio is, well, where did he put his stop loss? This is where he decided his stop would go. What is the distance from the entry position down to the stop versus the entry position up to where he would like to take profit?
Okay.
He's got it called the target. So it's become simple math. We just have to determine, and I think TradingView will do this for you, so you don't have to have a calculator on hand to calculate what is the risk-reward ratio. So you just take the amount of money. I would just say if the price here is right around 16,000 and it's going up to, we'll say 18,000, that's a difference of 2,000. You divide that by the difference from down below, which is 16,000, we'll say down to 15,000. So that would be 2 to 1, which is pretty freaking close to what he's got here. It's not quite. I always forget whether you do the small number on top or the big number on top. So I have to go do it, calculate it a couple times, and make sure I got the numbers in the right place to calculate the correct risk reward. Which is why I wrote it down somewhere. It's on here somewhere. Does that make sense? This is huge. And I think, like I said, I'm pretty sure if you go into TradingView and use one of the tools, I highly recommend using TradingView for your trading. I've been using it for years, and I'm still learning some of the cool things that it will do for me. And this is huge. Now, the hard part, of course, about this, the two hard parts, is deciding where your stop loss should go and deciding where you think you're going to sell at. I have been very good at buying and picking bottoms. I'm really good at that. Trying to decide where to sell, where the top might be, it has been my challenge, especially if we've got new all-time highs. What are you going to guess? So that's something to think about. Now, the question is how far down do we put our stop loss? I do believe that's a different training. We'll get into, how far below your entry point do you put your stop? I've heard people say 2%. I've heard people say 3%, and I've heard 10%. Would anybody like to share what you have liked to put stop losses at before?
I've always done 2 or 3%, so that's fairly consistent.
Okay, 2 to 3. That sounds reasonable to me. 2 to 3%, because I want to have a fairly tight stop. 10% seems a bit much. But what would this one be? If we've got 6,000 and this is going down to, we'll say 15,000, that's 1,000 over 15. Oh, I think I got it backwards.
1,033.
That move is only about that's 6.5% roughly. So that's more than 2, more than 3. So there is no set rule about what it should always be. I like where he chose his stop. He didn't choose it up here. This would have been closer to 2 or 3% if he had chosen a stop where these 3 candles sort of came consolidated a little bit. But he chose the bigger. Yeah, go ahead, Thomas.
That's probably where I would have gone up above.
These are stronger. These are stronger turnaround places, I would say. All right, let's go review his 101 here. So the bottom line is don't risk more than 3 to 5% equity on any single trade. Position size matters, not leverage. The size of your position matters, not the leverage. Well, we're not doing leverage, so the position size is whatever you put in. Therefore, you're only going to put in 3 to 5%. Your position size can be as big as needed when risking only 5% of your equity. Your position size can be as big as needed while risking only 5% of your equity. Yeah, well, that makes sense. He talks a lot with leverage in mind, which we're not wanting to do right now. Don't risk more than 5% on one trade. He says it over and over again. And he says, sorry, it might be boring, but this is the most important part of trading because that's how he lost everything 5 years ago by not doing this. So this concludes part 1, optimum position sizing. So I've got some more. It's highlighted in yellow. That's how I know I moved on to part 2. Entering the trade. This is part 2 of risk management. I think we can get through this. I wasn't sure if we'd have time, but I think we're doing good. So entering a trade without ascertaining a thing is gambling. I would say that entering a trade without having done your research, having looked at the charts and decided an entry point and an exit point is gambling. Don't enter a trade without determining the following. You need to have an entry trigger, a stop loss, and a target. It's those 3 things that we saw on that chart just earlier. Entry trigger, reasons for entering a trade. Why did you get in it? There could be a couple reasons or a single reason. This is why I've decided to start keeping a trading journal. And I wrote down why I bought MVI, and I wrote down why I sold it. So I'm keeping track of these things for myself, and I highly recommend you do it as well. And you can do it for those of you who are in the membership. If you're willing to take on learning how to use the spreadsheet, you can use my advanced spreadsheet. I'll upload the current copy of it because I've added a place to add the trading journal. It's just another tab. You can add your own tab if you know how to do that and decide what you want to keep track of. But I will upload my version as well. And I'm going to upload multiple versions for people who, so I don't keep overriding the one that I've already put in there. Generally, set of reasons, aka confluence, is higher probability trade and generally a safer entry. Generally, a set of reasons. I don't know. Sometimes his writing English is not his first language. It's quite obvious when you read a lot of his manuals. A confluence is a higher probability trade. Well, yes, that makes sense. And if you'd been a part of our trading class, the first three, when we talked about support and resistance, you would have a real clear idea of what he means by confluence, because the support and resistance is a confluence of where price action stopped in either direction. Okay, so he's talking about stop loss. The price in the opposite direction of the trade where the trade is exited at a loss. So we're going to assume that we're doing a spot trade, which means it's going to be long. You buy at a low price, hoping that it's going to go up into a higher price. And I'm trying to figure out what he's talking about in his words here in this particular previous resistance broken, entry made. This is his resistance. There's a confluence. I would have taken that out and see how it affected way back, further back than that. But he is a very much a short-term trader, by the way. I think he even uses bots. And he said, you might make as much money as I made with 2 or 3 trades, and he might make 1,000 trades. So I'm into the 2 or 3 trades, not the 1,000 trades. So just to let you know, that's why he's probably looking at minutes versus me, which I'm looking at days and weeks. So here we have resistance. Previous resistance was broken right there. Let's see if I can zoom that in a little bit more. So right at this spot here, you can see that the green candle broke through just right at the beginning of its candle. It just broke through this resistance point. So he says previous resistance broken, and he made an entry right there, which then took off. Trend line retest. So my question is, where did he set his stop loss? I would have said possibly, I don't know if I can draw well on this. I can maybe do a fake one. No, it won't do it. Won't do an angle. I would say that I would have extended this out and said, well, that may be where I would put my stop loss, is right at the extension of this trend line. And that may be what he's going to say. Let's see, he's got another example. Is this the same example? No, I can't tell. So the stop loss is about the price in the opposite direction of the trade, where the trade is exited at a loss. That's where you got to pick where you want to say, the line is drawn here. I will go no further, as I remember Jean-Luc on Star Trek saying one time. At this level, the reason for the entry becomes invalidated according to technical analysis, and price can then move in the opposite direction probabilistically. So here's again where he says he entered right at the bottom here. He entered, this was his resistance. It broke through resistance. He made an entry, and he made his stop loss apparently way down here. I tell you, that looks more than 2 to 3% to me, depending on what the prices are. So, but he hasn't said what percentage he would do his stop losses at yet. He has not told us what his theory is.
You know, in a very volatile market, it might need to be a little lower.
Yeah. Right now, with things going up so high and pumping, I might not have it so low. I tend to not trade, though, until things are ready to pump, because it's a lot easier. Target is the possible. So there's 1, 2, 3. I was trying to see. Oh, here's 3 things here. Let's go back up to the top. Here's the 3 things he's talking about. He just didn't organize it super well. Entry trigger, stop loss, and target. So we first talked about the entry trigger. That's number 1. The reasons for entering a trade. Have a reason. And his reason in his examples is, well, it broke through his resistance. Number 2 of that is, what is your stop loss? We can't decide whether it should be 2 to 3% or 10% because his seemed bigger than 2 to 3. And then his third thing you must have in order to enter a trade is your target. The target is the possible price level that the asset might touch based on previous trends or confluence and where a possible reversal could occur. Reversals can occur on a resistance line. You know, you can have trend lines, diagonal trend lines. There's all kinds of things. People pay attention to, the Fibonacci's, and there's so many things. I personally have simplified my trading over the years, and I've simplified my indicators. I find that the more indicators I use, the more confusing it is to figure out how to make a decision. Target is the next path of least resistance where the price might reverse. We will do all of these things using technical analysis. So we will determine all three of those things he just mentioned via technical analysis.
Okay, it's enough. Here's your water.
Okay, so I'm trying to figure out what he's trying to tell us here with his thing one, thing two. Okay. I think what I've seen generally in nomenclature is this T1 and T2 is take profit 1. Usually it's TP1 and TP2. So I'm not sure exactly if this is what he's talking about, but it seems like it. This is a resistance line. So if we got in down here, here's a resistance. That's a reversal. If he's thinking it's going to break through that, then he would have a take profit looking at past trends. He's drawing a line showing that's one potential take profit or an exit point. And here's another potential resistance line, a reversal, which is a potential take profit. So, you know, I'm curious to see how he deals with this because you don't know whether it's going to bump its head off of this or not. So I tend to not make my decisions until it's made a decision. It's either broken through or broken down. So I don't make my trade based on what it does when it hits that. I make my trade based on what it does after it hits it. Does it cross it up or does it cross it down? So let's see what he's got down here. A combination of the three coming together forms risk reward. Still not getting what this chart, what he meant for that to tell us. We will try to understand what really risk reward is in this thread. The risk reward ratio defines the relationship between the potential losses and potential gains of a trade. It's determined by the difference in entry price from, here's my definition that I wrote down. It's determined by the difference in entry price from the stop loss and take profit price, which we've already talked about, but he goes over it again here. RR is simply the risk, the ratio of the different distance between entry and target and entry and stop loss, which we've already talked about. And you guys all said you got that. And he does repeat himself a lot. And I'm fine with that because you can't hear this stuff enough until you really commit it to memory. So here's important stuff. Risk ratio is generally denoted in a ratio form such as 2 to 1 or 3 to 1. In his example up above, I think he had 1.87 to 1, something like that, almost 2 to 1. Did I get that right, Wayne? He said you should not be entering a trade unless the risk reward is known. This is huge. I've never entered a trade knowing what the risk reward is because I just kind of, I've read the charts. I have a general idea of where I think it's going to go, but I've never written down the numbers. I will from now on in my trading journal. This is an interesting section here. The myth that a fixed minimum risk ratio is necessary for taking a trade. I might be getting ahead of myself, but I'm going to say he has read that many people think that they have to have at least a 2 to 1 risk ratio before entering a trade. And he says, as it says here, the myth is you don't need a minimum, but you don't want to have a whole bunch of trades with too low a risk reward ratio. But in the example he gave, it was just under 2 to 1. So even Murphy in his book has advocated for the same, but in my opinion, it is a wrong benchmark to have. Oops. Sticking to a fixed risk reward ratio can prevent us from entering a high probability trade at times, especially if you know things are taking off. That's high probability. And if your risk reward shows in the next spot where you might take profit, it might not be a full 2 to 1. And he's saying that shouldn't necessarily be a reason not to enter. To accomplish this, most traders use a risk reward ratio. For each potential trade, a profit objective is determined. That profit objective, the reward, is then balanced against the potential loss if the trade goes the wrong way, which is the risk. A commonly used yardstick is a 3 to 1 risk ratio. That's pretty big. I don't know how they ever got that in the stock market. Maybe in the options it was possible. The profit potential must be at least 3 times the possible loss if a trade is to be considered. And he disagrees with it. He says doesn't have to be set in stone. So what is the right way to use risk reward ratio, and how do traders with low win rate turn out to be profitable? Profitability depends on 2 factors, the risk reward ratio and your win rate. So over time, you'll figure out what your win rate is. Try to say all this fast, I swear. It's why you want to keep your trading journal. You'll be able to calculate your win rate, and I would keep track of the risk reward ratio. I think I've got that in my journal as well for each trade. And see, I'm not a heavy duty trader, so I don't have thousands I'm going to have to keep track of. My trades are, I'm a swing trader. I call myself a midterm swing trader. So I'm not going to trade every day. I'm not going to trade every other day. I'm probably not even going to trade every week. My position's set up and might take a couple of weeks or a couple of months to play out. So then I don't have so many to enter in my journal. So this is as much as I was planning on going over today. I think that's a good amount of material. If we were to do a quick review, I'm going to back up to his list. I can do that without making us crazy. Before entering a trade, you need 3 things. Your entry trigger, what is it and why is it? Your stop loss, how are you going to determine how much below your entry to enter? He never did give us a percentage, did he? He kind of hinted at it by saying 2 to 1 or 3 to 1 isn't necessary. It isn't necessary for it to be that big. So that hints at what his stop loss might be. Because when you calculate your risk reward ratio, if it's lower than 2 to 1, it doesn't necessarily mean you should ignore it. I think he purposely didn't share a percentage, but I would personally start around 2 to 3% and see what that does to my risk reward ratio. And if it's within, if my risk reward ratio is like 0.5, I might not enter that trade. It's just not quite enough. I would say it needs to be at least over 1.5. Personally, I would prefer to see 2 or 3 or even 4 or 5, because like I said, my trades are longer. You can make the same amount of money making a trade every day or every other day as a person can make trading once a month, because the thing is going to go up the whole time. It's like this last bull run that we've just had, this last pump started January. I think it started around October, middle of October, and it's gone up and up and up and up and up. But some traders will go, buy, sell, buy, sell, buy, sell, buy, sell. Me, I'm all about buy, sell. I don't want to do all those gyrations. So it really depends on what your strategy is and what you want to accomplish, how this plays out for you. Comments, questions, thoughts? The floor is open, because that's as far as I was going to go today. That's a good training on risk management. John can do a trailing stop loss. Yeah. That's right. He did. Yeah, let's talk about trading stop losses. I don't think I've ever set up a trailing stop loss. John, do you have a particular platform that you like to use to set your trades up and that allows trailing stops?
No, that's something that I had learned when I was doing options.
Yes, it sounds very familiar. I don't think I ever set a trailing stop. I think I just set regular stop. Was that a question or a comment? Are you wondering whether crypto allows?
Yeah, I'm
trailing
wondering
stop?
if you can do it on a crypto platform. I'm assuming so.
That's a really good question. I think that question is worth asking. You know what? I think I get better answers using ChatGPT. So let's go look and ask.
Didn't he mention something along the line, or you mentioned something along the line, the leverage times capital risk, and you said the leverage was 1? Is that what you're talking
Well, yeah.
about?
So don't overthink it. Don't overthink it. If we're not using leverage, then our leverage is 1. You see, if we're not using any leverage, then our capital is just whatever we're putting in. It's 5,000. Our leverage is 1. That's how much we're putting in. If you put in $5,000 and you want to leverage 2x, your leverage is 2x. Your capital is 5,000. If you're leveraging 2x, you do 5,000 times 2. So your working capital is actually 10,000. Does that help, Wayne?
Yes, it does actually. Thank you.
You're welcome. Only 4 spot crypto exchanges. These are not decentralized exchanges now. They never give me an answer about decentralized exchanges because it's decentralized. The system never seems to know. But the spot exchanges that allow for trailing stop orders are Bitfinex, Bitstamp, OKX, and Liquid. I'm surprised. What's the one I have? I'm surprised Bybit isn't on there. 4 crypto spot exchanges and 3 derivatives exchanges: BitMEX, Binance Futures, and FTX. Shows you how old this is. No crypto exchanges support trailing stop limit orders. If you are trying to find trailing stop on Binance or Coinbase Pro, you are out of luck. I use Coinbase Pro. This shows me how old this comment is, or this whatever post is. It's Coinbase Pro is what I've been using for a long time, and it doesn't exist anymore. They folded Coinbase Pro into Coinbase, and they call it Advanced Trade now within Coinbase. Instead of having 2 separate platforms. It used to be 2 separate platforms. What I think they did is they took their Coinbase Pro platform and turned it into some kind of an institutional platform. So I'm curious to see if we get any other, probably not going to get too much more. That's probably all it had to say. Top crypto exchanges with stop loss, stop, and trailing stop. If I haven't heard of them and they're not a big exchange, I ain't touching them. I cannot tell you how many people I have spoken to over the years who have been scammed to the tune of as much as 40 grand. One guy sent 40 grand to an exchange that was a fake exchange. He didn't do enough due diligence. I literally talk to these people and I do 10 seconds of due diligence and I'm like, I think that's a scam exchange. It doesn't take much to just check. It doesn't take much to ask, is this a scam exchange? And read what comes up. And it was pretty quick, easy for me to, and I'm so sad I had to tell people that people put a lot of money on exchanges because they promised all these huge returns. Not a reason to trust it. So I just say, please be careful and do not use exchange. Yes?
CJ got caught the other day, didn't he?
I don't know. What about CJ?
Yeah, 20 grand. 20 grand. He said he posted it. He said he didn't, before he pressed enter, or send, he didn't check something. He's just been a bit
Lazy?
Yeah, he wasn't being careful. So he pressed enter and lost his 20 grand. And he's
That's probably
Yeah.
chump change for CJ, but that's still, yeah. CJ is one of the guys that that's in our network that is degen. He's the degen of all degens. So I don't even pay attention to half the stuff he talks about because it's so degen that I can't research. He posts 10, 20 projects every other day and he chases them, but he also loses a lot of money and he makes money. So that's his style. It's not my style. So I'm curious if there's any I'm going to try asking this question on one other, let's see, let me ask it a different way. I don't know if it'll help. Let's see if any decentralized. See, I don't believe the decentralized exchanges that I know of that offer perpetual, well, perps are only if you're doing, if you're only doing leverage, but there are several exchanges that are decentralized like GMX. And I know they have stop losses. Philippe, have you heard whether they have trailing stops on GMX?
No.
Okay, let's see if we get any
No.
answer. The following crypto exchanges support trailing stop losses. Look at that. Now we've got totally different lists here. Bitstamp, it says Kraken. Now, Kraken is a US exchange that I have an account there. BitGet, I think they've been around a while. I've never heard of this other one. I wonder if I can let me change the time frame and just go how far back do you guys think I should go? I'll give it can I change the year? No. I think I'm going to go back since it's taking forever to go too far back. I'm going to just go back to January 2022 and see what it finds. Okay, so just going back to January 2022, it says Kraken has trailing stop losses. So now these are centralized exchanges, but I don't do all my trades on decentralized exchanges. I do a little of both. So what's my centralized exchange? My number one choice is Coinbase because I've been on them since 2015. And I have tried Kraken. Kraken has a little bit higher fees. And because I use advanced trade on Coinbase, my fees are lower. But Kraken is a nice exchange. So if they've got trailing stops, that's one I would consider.
In Coinbase, if you have the advantage, so you pay every month.
No, that's different. Now the pay every month thing is I think they call it Coinbase One. That's another option. You do not.
Okay. So that is for free, no? When you do, they don't charge you nothing, no? It's free because you pay $30 every month.
No. I do not pay any monthly fee to use Coinbase. I do not use their Coinbase One. That is a subscription that you can sign up for if you want. If you make tons of trades in a month, then it makes sense to do it. But I pay them by how much I pay per trade.
Oh, okay.
See, the Coinbase One, which is a flat monthly fee, is I think it's $30 or however much it is.
Yep.
And you can make I think you can make as many trades as you want. And so that can be very good if you make a lot of trades.
Yep.
And I don't. So I just pay whatever their fee is for when I initiate a trade. And what I'm saying is, if you initiate a trade through their simple trade, not using Coinbase One, you will pay double in fees what you will pay if you use advanced trade. The fees are about 50% less in advanced trade. And advanced trade is where you set stop losses and limit orders and do all that. You cannot do that in simple trade. Well, they may allow, John, thanks for being here. We will connect later on. You've got my email and my phone number. And if you text me to the right number, I will respond to you.
Sounds good. Thank you.
You're welcome. Take care. Nice to meet you.
Nice meeting you.
So I just use simple trade. I think does now allow limit orders. I think that's a new thing, but they do it in a weird way. So if you go to set up a limit order on Coinbase, they force you into your limit order has to be at least something like 1% different from the current price. Whereas if you go into advanced trade, you can set that limit order at whatever price you want. 1%, 0.5%, 0.2%. It's up to you.
Yeah. Even if you don't, well, no, you have to already pay $30. But the other day I got one AVAX because I needed for the gas in MetaMask. So I got one AVAX in Coinbase, and they charged me $1.99 just to buy one AVAX. So that's why I asked you if you pay, because I think $30 if you start doing some trade, $30 is very, very convenient, no? To pay
100%. But I don't really understand how, if you sign up for Coinbase One is what it's called, or what it was called, where
Yep.
you pay a flat fee. I know that affects the simple trade side. I don't know how that affects the advanced trade, because the advanced trade charges you a fee, when you make your trade. I'm thinking Coinbase One only affects the simple trade side, but if it does, and you don't care about limit or well, you can do limit orders now, but if you don't care about stop losses and all that, simple trade is so much easier to use. And now you don't end up paying double the fees because of this flat monthly thing. Does that make sense?
Yep.
Yeah.
Yep. And if you convert, like instead of convert is more expensive too, no? You know that you can convert in Coinbase.
Yeah. If you sell a token in
Crazy, yeah.
if you sell a token in Coinbase, you're selling it back into a fiat currency. In our country, that would be US dollars. And they call it converting if you actually trade your token for another token. And yeah, if you sell into USDC, it's very, very cheap, if not free. If you sell into USDT, it was really expensive the last time
Yeah.
I tried to.
I know.
Yeah, it's all about competition. They don't, they want you to use USDC because they're in bed with the Circle and is it JP Morgan, or is it whatever bank that's behind USDC. So that's why. But it depends on what you want to do. I don't do enough trades to pay the $30 a month.
Okay.
So I just go in and use advanced trade when I want to, because it's 50% less than I would pay in simple trade. So if a trade for $1.99, you bought one AVAX and you did it on simple trade, and their base fee for that amount was $2. And if I had done that in advanced trade, probably would have paid half that.
Okay. Wow. It's good to know.
Yeah. Awesome.
Wow.
Any other comments, questions, thoughts before we consider closing today's meeting?
It's great.
While it was very
Can I just
interesting.
have a quick question, please?
Let's
Phil. Go, Philippe.
Wayne. I'm going to let you talk, Wayne, but I'm going to ask everybody to raise your hand so I can call on you, because we had a few people trying to ask a question at the same time. But if you raise your hand, that way I'll know who has a question, and we can go in some kind of a reasonable order. So you go first, Wayne.
So just a quick question. This is the first training thing that I've been on, because I'm normally doing things on a Friday, but I'm going to try and alter my routine so I can get on these. And so when I click on the link that you provide for to re-go and visit the teaching, I haven't been able to get on to connect with any of those. So I was wondering if you might be able to help me on that, please, because obviously this temporary BTC and anything you're sharing anyway, or any of the others are sharing, is really important. And I need to get grounded in it. So is that, yeah.
Well, that's something we maybe can
Is there
deal
somewhere I
with
can go? I know
after
they're
the
written.
class. Yeah, that sounds.
Okay.
I don't know why you can't play the videos. The videos are the links to the videos that I put in the Knowledge Center are Google Docs. They're from Google Drive. So it's a link to a document in Google Drive.
Yep.
You should be able to open that. You don't have to have an account to be able to open it. This particular training from today, these different videos, these will be available on YouTube. And I will put the YouTube link in the membership site as well, but you'll be able to find these on YouTube. So that'll be hopefully you'll be able to access these. I don't put all of our trading classes and all of our deep dive calls on YouTube, because that would make it open to the entire public. And that's not what I want to do. They're available to members most of the time. So if you're not able to open them,
Yep, all good. Thank you.
I'm not sure how I can help, because that's more of a technical computer issue, but we can try. I will let everybody know that Wayne is in Australia, which is why he says this call is on a Friday, because for us, it's on Thursday, but for Wayne, it's on Friday. So I didn't want to confuse people, because I actually do another deep dive call on Fridays in another group. So that call would be Saturday
Which
for
is
Mr.
Saturday,
Wayne.
our time.
Yes. So keep trying, Wayne. Keep trying, seeing if you can open those videos, and if you can't, I'll do my best to try to help you. I'm just not sure how I can, but let me know if you still have trouble. Okay.
Yeah, no, it's all good.
Awesome. Philippe, go for it.
Yes, the first part that we saw today, where are you going to put in Let's Crypto program, where I can check the recording?
Yeah, very good. The deep dive calls always go in the community section under the deep dive. Remember, under the community tab?
Okay, I got it.
Yeah.
It.
So
Yeah,
if you go into, there's deep dive call, and then there's the deep dive recordings, and I put the recordings in there by month. Yeah, so I
okay,
will,
got it. Yeah.
I'll put it in there. And then the trading class, we decided to put the trading class recordings under the trading tab. So it'll be right in the same area where the manual is kept.
I see it. Thank you.
You're very welcome. Very welcome. Does anybody have a question that isn't necessarily a member right now, but would like to ask a question while we're all here? Please feel free. Okay. Philippe, go for it.
Nobody asking questions. I'm gonna ask, do you have something in Trader Joe, or are you looking for something in Trader Joe?
Specifically for Trader Joe, what the reason I staked in Trader Joe was I wanted to qualify for the Mo airdrop.
Okay.
I haven't done anything else in Trader Joe. I don't much care for their let's see if I can bring it up here. Their V2 pools are a bit convoluted for me. I can't quite figure out. I don't know why it's not loading. Let's pick one. So yeah, the liquidity things, I'm hoping one of these days they're going to make this easier. Sean says, I searched for the YouTube page, haven't found it. Oh, thank you for mentioning that. Let me give you the link to my YouTube, because it can be a little tricky. Let me come back to the Trader Joe question in a sec. And first, let me bring up, share my link to my YouTube channel, because it's actually under Kelly Sunshall. The name is Life with Crypto, but it won't show as that. So let me go in here under, give me one sec, marketing, assets, social links, and we get Facebook, Twitter, YouTube. All right, here's the way to find me on YouTube. Oops, not that. Didn't get the whole thing. There it is. All right, there's the, oh, it missed the L. Here, skip that. That won't be the right. That won't get the whole thing. It didn't catch it all. For some reason, this doesn't want to copy. Let's try it again. Keeps cutting off the last two letters. Wow, yeah, I don't know what's going on. Let me just do it this way manually. Let's see if that caught it all. AWL. There we go. So that link, the one that's at Kelly Sunshall, not at Kelly Sunshaw. There's an L on the end. And here's my actual YouTube channel that's Life with Crypto, but they won't let me have my own name. It's a gobbledygook for the end. Both of those two links, the Kelly Sunshall and the one I just gave you, will get you to my Life with Crypto YouTube channel. Let me know if you have any trouble finding it before we go. Okay, so back to Trader Joe. You know, if you do, let me zoom out a little bit. It's too much zoomed in. I'm at 100. So where do we have V2? I go back to the pools. You'll notice we have up here, for those who don't know, we have V1 pools and V2 pools. And the V2 pools, of course, is concentrated liquidity. Zoom back in a little. So if you pick one of these, APR for AVAX and USDC, OMG.
Yeah, they have a very good APR.
OMG, this is why you got to pay attention when you start these bull runs. OMG, I haven't been here for a while. And 256% on a half stable coin position. This has got to do with the fact that AVAX has just been on a tear.
In Arbitrum Ethereum, I think it was Arbitrum Ethereum, it was almost 600% yesterday when I checked.
What platform?
On Arbitrum.
On
Yeah.
which
Trader Joe.
on
Trader
Trader Joe?
Joe. Yeah.
I didn't know Trader Joe was on Arbitrum. Oh, guy, I keep forgetting that they've expanded to all these different chains.
Yeah.
Because it used to just be Avalanche. Yeah, the Trader Joe or the Avalanche ecosystem is really doing well right now. This is fantastic. I mean, that's huge volume, good liquidity. Yeah, that's cool. It's just that I don't like doing V3 pools during a run up because you're going to have impermanent loss.
It's complicated. Yeah, you are always out of range. Yeah, I tried with 2 different yesterday, and I say out of range the next day. It's So yeah.
So let's look just while we're here, since you asked. Let's go look quickly at the V2 pools, or not V2, V1. Let's see, is it showing them? Let me see. No, it defaults to V2. Do they even have V1 pools anymore?
I didn't check V1, but I know I just put I have an Arbitrum and an Ethereum, so impermanent loss. I don't care if I have Arbitrum or Ethereum because they are both good, no? So
Yep.
I
agree with you. That you just have to keep in mind that, because I did the same thing with my AVAX on GMX. I was like, but it's a little different on the old GMX because it was GLP. I sold all my AVAX and bought GLP. And then when I closed my GLP, sold all my GLP back into AVAX. Because AVAX had gone up so much in price, I got a whole lot less AVAX back. I got the same dollar amount, excuse me, but I got less AVAX.
AVAX, yeah.
Yeah. So I got less tokens, but same dollar amount. And I was like, shit, I didn't really like that idea. So you just have to be careful when you open these V3, or well, we call them V3, but they're really just concentrated liquidity. That if you go out of range, you're going to end up in one or the other of these 2 tokens. And if you like both tokens, then it's okay. It's just that you might be buying one of those tokens with the other token at a price that you'd rather not buy at. So the concentrated liquidity pools are more complex. And for people that are just getting started in DeFi, want to make some passive income in DeFi, I do not recommend playing with concentrated liquidity. You want to learn how to do regular pools first. And it doesn't look like it's showing me. I keep clicking on V1 pools and it's not bringing anything up that I can see. That changed, so that's good. Let's see if that didn't change though. The pools did not change.
What about the auto pool? Auto pool is like in Gamma. They reset the pool, or
in Gamma? Are you switching over to Gamma on me now?
No. I mean, you just, I don't know, just go back 1 or 2 back, and I say auto pool instead. Yeah, there on the left side down next. Yeah, auto pool. That is like Gamma, like they reset.
This is where they
I don't know. I just
asked
a question. I just asked a question.
Good. Well, auto pools, you would assume that means auto compounding, right? Is that the question?
Yes.
Shit, that's pretty good too.
I don't know.
Pardon my French. 158% on. So is this concentrated or not? The way you can tell is if you come and look at it and you don't see those 3 pretty pictures that we saw a minute ago, that means it's not a concentrated liquidity pool, and I would be interested.
Okay.
157% on a liquidity pool that's not concentrated. Holy Toledo. Now, automation fee. So you got to take into consideration, this is auto compounding. And I don't know if it's auto compounding using concentrated liquidity or not, because it's auto compounding. We tend to not care so much, but they do charge a fee of 4.5%. So you would have to take 158% minus 4.5%, and that's what your actual APR is. That's still pretty freaking good.
Yep.
Liquidity is great, $5 million. Fees in the last 24 hours is 24 grand. That's really good. So if we go to the pool page, see, it is concentrated liquidity. So their auto pools is similar to Gamma. It's auto compounding, and it's a what we call V3, which is just our acronym for meaning concentrated liquidity. So yeah, it is. So if we go back, let's go back to the pools. Auto pools are auto compounding, and they use the liquidity book, their Trader Joe's version of concentrated liquidity, to set the position. I can't find anything that says we can get into a V1, a non-concentrated liquidity. Every time I click on it, it doesn't do anything, which is interesting. They really want people to use their version 2 concentrated.
Yep.
Nothing will come up. So that's all we're getting at the moment. Let me see all pools. That does anything, because you can't tell looking at it here which ones are concentrated and which ones are not. There's no hint. Well, does that answer your question good enough, Philippe?
Yes, sure. Thank you.
You're welcome. This is the Gamma protocol that is also concentrated liquidity, and they just don't have as good a rates. There's one that looks pretty good, Rapmatic and USDC. Actually looks real good, but I'm just not wanting to do concentrated. Not at this time, not when we're pumping. Is there a link to find out about the membership? Oh yes, I'd be happy to share a couple of links. Thank you for asking. Let me see where I could go grab those real quick. Let me stop sharing my screen. Let me stop there for a moment. Let me go over here and grab some links. Actually, I can't get them there. They're over here. This is a really good call. It's been good for me. I hope it's been good for you guys. So as far as learning about the membership, you have two choices. You can set up a call with me and we can talk about it, because here's one link to my calendar. That's one option. And the other option is just go straight to the registration page. The thing about my registration page isn't as up to date as the information that I share in the call, because I haven't had time yet to go and update it. And that's on my agenda. So I can show you what it is. Now, I have one, as I mentioned earlier in this call, I have one mentorship position or spot open. So I'm giving you the link to the mentorship, and the first person who gets that gets it, because this registration page will be going away, and I will be turning it into the new one after this call. Probably get it done by early next week. So there's two links for you, Sean, one to my calendar and one to sign up for the mentorship. And I don't know if I said, but the mentorship right now is only $1,500. It's a steal, and it's going to be going up nearly double starting next week. Any other questions, comments? So did you guys, we've lost people along the way, which is what I expected. Thanks, Sean. We started out with 17 people on the call, and we're down to 5 now, but this has been nearly 3 hours. I did not expect everybody to hang on for 3 hours. You guys are the diehards. So thank you so much for being here with me today. I do have to give a little caveat that I have to say that this is not meant to be financial advice. Even though I was an accountant for years, while I had my license, I was able to talk to people legally about their finances and advise them. Since my tax license is no longer active, I have to jump on the bandwagon that says, I'm here to teach you to fish. My goal is for you to fish for yourself, because crypto is constantly changing. So if I were to just give you the fish right now and say, this is how you can make money right now, 6 months or a year from now, it'll be different.
Yep.
And I will have done you, in my opinion, a disservice, because I wouldn't have shown you how to change with the times. So I'm here to teach you how to do it. And we go over our weekly calls, and I'll answer as many questions as I can. We'll do a deep dive and make sure you understand it so that you can do that. And this is how we do it. So if there's no other comments or questions, it's going on 3 hours. I think I'm good. Philippe, you lasted a long time today.
Thank you so much. Thank you so
You're
much for
welcome.
everything.
You're welcome. Sean, thank you so much for hanging out and for sticking with us. Look forward to talking to you. And I did put my phone number and my email address in the chat, so you should have that there if you want to connect with me that way. And Sam, we didn't get to see you today, but you've stuck out with us here. If you'd like to say hi or bye before we go, we'd love to do that.